So good morning, everyone. Welcome. I am Yvonne Schwab, ACG Silicon Valley CEO.
Hi, I'm Christy Dankos. I'm the Executive Director with ACG Boston.
We are very excited to present you today's event, Technology Investment Trends from Coast to Coast. And I am truly honored to be collaborating with our sister chapter, ACG Boston, on this. Both of our chapters are offering a variety of virtual events in the coming months. We invite you to visit our website to see the full calendar.
We just want to go over a couple of housekeeping notes before we get started. First of all, we'll have a panel discussion for about the first 45 minutes, and then we will open it up to questions from the audience. Feel free to submit any questions in the chat box. Probably might not have time during the event, although feel free to drop them in there and then we'll get to them at the end. But we'll have about 5 to 10 minutes towards the end of that to be able to do that. And then following the Q&A, we'll move all the attendees into several rounds of breakout rooms, so you'll have a chance to connect with one another and meet people from both coasts. Hopefully that's the excitement about us doing this together. We will be recording the content today, just the content, so don't worry about what you say in breakouts. And we'll be able to share that with you afterwards if you wanted to re-listen or share it with colleagues after the event as well. Just a couple of suggestions for optimizing your Zoom experience. I know a lot of you kind of know the drill at this point, but at the top portion of the screen, if you click on the view, you can activate the speaker view so that you get a good view of the panelists, and we'll have them pinned as well. So you'll be able to see the speakers a little bit more than all of your lovely faces. We do just encourage and make sure that you're all on mute just to make sure we can hear the speakers as well. And you're welcome to shut your camera off if you would prefer to listen that way, but that's ultimately up to you. And that's it. Back to you, Yvonne.
Okay. Thank you, Christy. And of course, we would like to thank all the companies who serve as sponsors for our chapters. Without them, nothing we do would be possible. And that goes for our members as well, of course. Now, without further ado, let me introduce you to our moderator today, Yvonne Lutsch. She is an investment principal at Robert Bosch Venture Capital's affiliate office located in Sunnyvale, California, responsible for sourcing, evaluating, and executing investments in the USA and Canada in deep tech fields like artificial intelligence, industrial IoT, mobility, quantum computing, or sensors. Yvonne, take it away.
Thank you, Yvonne. A little bit confusing with all the Yvonnes here, but so far we made it. Yeah, thank you everyone for having me. I'm very honored to moderate this panel with 4 fantastic speakers. We have Carrie Ford. She's from G2 Capital Advisors on the East Coast. We have Bernhard Gold. He's with Relay Ventures here in Silicon Valley. We have Jeremy Siegel from a software company, Progressive. We have Chris, and last but not least, Chris Bisbee. He's with Great Hill Partners. And so we have people from the East Coast and the West Coast, and I think they can introduce themselves even better than I can. So please, Carrie, go ahead and introduce yourself.
Sure. Thank you, Yvonne, and thank you, ACG, for hosting this event today. Happy to be a part of it. My name is Carrie Ford. I lead technology and business services for G2 Capital Advisors. G2 is an industry-focused investment bank. We are headquartered in Boston with additional offices, including San Francisco, which is in keeping with our East-West Coast theme here today. We operate primarily in the lower middle market in technology and business services, industrials and manufacturing, and transportation and logistics. And one of the areas where we really differentiate ourselves is in our operational focus. All of our industry practice leaders, such as myself, have operating experience in our industries of expertise in addition to being advisors. Our service offerings are designed to support our clients throughout their life cycle, from growth through maturity. And in that, we offer buy and sell side M&A, debt and equity capital markets, and we have a full operational and financial restructuring practice. I've spent my entire career in technology and business services as an operator, advisor, and investor. And I am very pleased to share the screen with this great group of professionals today.
Thank you, Carrie. Bernhard?
Hello, good morning. My name is Bernard. I'm based here out of San Francisco. Originally, I'm from Germany. I started my venture career at Deutsche Telekom, or T-Mobile here in the US, first in Germany, and then moved over in 2010 to head the investment activities of T-Mobile here in the Silicon Valley. And recently I joined Relay Ventures for this. Besides our head fund, just raised a bunch of vertical funds or SPVs in the area of prop tech, fintech, gaming and entertainment. And the last one I'm currently working on is mobility. And I think I'm representing the venture side here, and of course the Silicon Valley. We've been living there for 11 years now.
Thank you, Jeremy.
Thanks, Yvonne, and thanks to ACG for including me today as well. Real excited to share some insights on this exciting topic. So I run corporate development for Progress Software, which is based outside of Boston. We provide a suite of solutions that help our customers to develop, to deploy, and to manage mission-critical applications. I've been here for a little under a year at this point, heading up corporate development here and really helping out Progress as we execute a pretty ambitious goal of doubling the size of the business over the next 4 to 5 years, with inorganic growth being a key driver of that. I've spent over 20 years in corporate development roles in the Boston area at Akamai Technologies and LogMeIn prior to joining Progress Software. So I've had a lot of fun doing deals, over 40 deals over the course of my career, and looking forward to sharing some insights on what we're seeing today with this the rest of this panel and with the attendees here today. Thanks.
I'll finish. My name is Chris Busby. I'm a partner at Great Hill Partners, which is a Boston-based growth equity firm. We currently manage a little over $7 billion of capital, investing out of a $2.5 billion fund. And our focus is to exclusively look to find companies that I'd say are typically enterprise values between $100 and $500 million, certainly at times going above that level. Looking for companies that are generating attractive organic growth rates, north of 15 or 20% a year, going after large market opportunities, and tend to spend time in a pretty wide distribution of technology or technology-enabled segments, things like healthcare IT, financial technology, even some B2C on the e-commerce side, as well as a variety of B2B software and technology-enabled services sectors. So that's where we spend our time. I've been with the firm for over 20 years, lead our efforts across a wide variety of the B2B software sectors, and excited to be here today.
Thank you, Chris. I will add a little bit about myself, even though Yvonne already introduced me a little bit. So Robert Bosch Venture Capital is the corporate venture capital arm of the Bosch Corporation, a large German-based industrial conglomerate of many different businesses, mainly in mobility, in industrial IoT, building technology and consumer goods. I have been with the company for more than almost 19 years. And as Carrie also mentioned, I have a strong operational experience for the first 15 years. Came to US 5 years ago and started a innovation hub here for one of our divisions, and joined the venture group 3 years ago. My background is I'm a physicist, so also very technical focused. So starting with a panel discussion, I'm very excited that we have such a diverse panel. So we have like early stage investors, we have private equity, we have, you know, more on the financial side and advisory services, and also, you know, people with a strong ambition for M&A. So the whole spectrum actually. Interesting for me to know is what investment trends do you currently see across the US from the West Coast to the East Coast, whether they are accelerated by COVID or not? And trends can be both, right? Technology trends, but also like trends in terms of what is changing in the industry, for example, in valuations or in the deal process itself. I think it's an interesting question to be answered for each of you. Who want to start?
I'm happy.
Oh, yeah, go ahead, Carrie. You go ahead.
You know, I think that many of the trends right now really have been driven by COVID. I mean, obviously there are others that are outside of that, but it's just been, you know, such a, you know, so dominant in the market, obviously over the course of the last year in driving increased acceleration of digital transformation across the board, you know, whether we're talking about work, education, entertainment, consumer. We've really covered 4 or 5 years of growth in the course of a year. That's also lended itself very much to an elevated role of technology within corporations and schools and our homes, which has driven a lot of investment both in, you know, organic, inorganic growth across the board. You know, the movement of consumer habits to digital channels has been obviously incredibly significant. Outside of some of that, I've also seen a continued drive for efficiencies and cost controls that come through technology investments, and also really companies trying to get a handle on data as an asset and the usage and protection of that data. And I would say in regards to the deal process, COVID has certainly impacted the way we run engagements as investment bankers and as, you know, buyers and sellers are interacting. And, you know, previously we certainly would never have envisioned running a deal without many in-person touch points, but it's worked, right? It hasn't been perfect, but it really has worked, and even created some efficiencies around time and information transfer. I certainly see that we are going to go back to in-person. We're starting it. I'm hoping personally that we can accelerate that a little bit here, but, you know, I don't believe that we'll ever go back to the same extent of in-person that we ever did, as we try to maintain the benefits of some of those efficiencies.
Jeremy, you want to add something?
Sure. Yeah. No, I think, you know, it's interesting. Certainly, when COVID hit, we were certainly, from an M&A perspective, curious to see how long the pause button would be in play there. And I think, you know, there was certainly a short pause from an M&A standpoint, probably back in Q2 last year. But I think that changed pretty dramatically starting in Q3, and the level of activity from an M&A standpoint just grew exponentially over the course of the second half of last year, and certainly into this year. But I think what was interesting too, from our perspective, was just, you know, from a valuation standpoint, I think there was the assumption that, you know, maybe valuations would come down a little bit, businesses would be affected more because of COVID. But I think, to some of the points that Carrie made, you know, with digital transformation, and particularly in the areas that we play in, infrastructure, software, and DevOps, where there was a continuous demand for these technologies, these businesses were incredibly resilient and really were unfazed. And, you know, as a result, valuations, if anything, just continued to grow, and multiples just continued to expand. And that's something that, you know, I don't think we necessarily anticipated multiples expanding at the level that they did. Battery Ventures did an analysis that they put out earlier this year, and, you know, even for companies that were growing sub 20%, which typically demand lower multiples, even for those businesses, you were seeing multiples over more than double from 2019 to 2020. So just really fascinating how that multiple expansion happened. And I'd say another thing that has been interesting for us from an M&A standpoint is just the competitiveness from a PE and a PE-backed strategic standpoint in deals that typically in the past strategics would have more of an advantage because of the additional synergies that we could generate and the ability to pay more. the PEs, and Chris is right there, are now able to, with the deep pockets that they have now, are able to be competitive from a price standpoint, while at the same time being differentiated from a certainty to close and speed to close standpoint, which we're seeing more and more sellers put a greater emphasis on, that certainty to close, that speed, and potentially being willing to take less from a purchase price standpoint to get that certainty, to get more appealing deal terms. And so, it's been interesting to sort of see some of those new trends.
Yeah, maybe Yvonne, I can complement that from the other side, the early stage or venture capital side. So similar picture here. So we actually many are wondering, are we in a bubble? And if yes, will it ever like burst? And when will that happen? And then the pandemic hit, and maybe people like, I was thinking, okay, that's it. We see maybe not a burst, but at least a slowdown in the market. What we actually did for a month or two, and then it came roaring back, and it ended up that 2020 was the second best or second largest, just like considering the amount of money deployed worldwide, actually, not only in the US, in venture capital history, what's quite remarkable. And it's not stopping or slowing down in 2021 either, right? If you look at the last couple of months, actually. What is like really interesting, because somehow like the whole pandemic and COVID-19 really was like, of course, driving digitalization in general, but also like really driving our markets. And the same here from the early stage. It's just like valuations are getting just like higher and higher, and there is actually no end in sight. So I think that applies from the very early stage to the M&A to the end, basically.
Yeah, and I'll just jump in. I think there's a couple of other things that feed into this. I mean, first and foremost, there's obviously just a tremendous amount of liquidity out there, whether it be strategics with cash on their balance sheet, private equity firms raising record funds year in, year out. And there's just a supply-demand imbalance. You have a tremendous amount of capital that people are looking to deploy. And frankly, there, I think, has been a flight to quality as it relates to the businesses that are coming to market and where those businesses are transacting. And so while there's clearly a lot of activity in the market, I think part of that activity is driven by folks looking at who performed well during 2020 and wanting exposure to that, feeling like it is lower risk versus areas where potentially some segments where they face greater challenges. And I think technology, it's obvious, technology is probably the area that weathered 2020 better than maybe any other area of our economy. Certainly on the software side, you saw, frankly, remarkably high retention rates within customer bases and revenue streams. And so I think when you look at folks, whether they be private equity firms or even strategic buyers, they're looking for more exposure to those types of businesses based upon the experience of 2020. So you have all the folks who've always been just technology investors for years, and now you have other folks who are dipping their toes in the water, wanting exposure to that area. And I think it just, again, continues to contribute to remarkable demand for high quality technology businesses and a limited supply of those businesses in the market.
And Chris, I was wondering, and maybe you want to say about this a little bit. Are there any differences? Do you see differences in the valuations? Because we all realize that valuations, across all stages of companies are getting higher and higher because of the money available. Do you see a difference between the East and the West Coast or not?
I think that, first of all, I think that valuations are robust everywhere. So I'll start there. And I think that there's so much, whether it be private equity firms or other sources of buyers who have lots of resources to try to look under lots of rocks to find good businesses. I think in the past, maybe we convinced ourselves that if we were looking at a software business in Ohio or Alabama, there'd be less competition than there would be in Massachusetts or California. I don't know that that's the case anymore because there's so many folks looking desperately for these businesses and these assets. In the end, I think if you were to do an analysis, I wouldn't be surprised if you saw higher multiples potentially in certain geographies, and Northern California is probably one of those geographies, and it might be higher there than any other place. I don't know if that's just a geography issue or if it comes down to growth rates and the market opportunities that some of these companies are going after. And I think that there has maybe been, there may be more venture-backed companies who are potentially delivering higher growth rates, maybe with greater burn, but higher growth rates on the West Coast than in other areas around the world. And that those growth rates are, I think, what translates to valuation as opposed to geography. It's correlated, but I don't think it's caused by geography. I think it's really going to be the growth rates and the underlying business models that drive valuation.
Okay. And in terms of differences between East Coast and West Coast, we talked about this a little bit in the preparation call. And Carrie, you mentioned that even though with COVID, there's much more movement, it's not so important anymore where you actually are really located, and people are moving around a lot because you're working virtually from anywhere anyway. But do you still see differences in the cultures in the East and the West Coast, and how you deal with it?
Yeah, I mean, I think that there certainly is a difference in the culture, and I think that there always will be. I mean, traditionally, the East Coast has been seen as more conservative. The West Coast has been seen as a little more laid back. There have been, and this kind of goes to what Chris was saying, differences in the typical stage of companies transacting and the relative focus on top line versus bottom line. And both coasts have sort of had their regional cliques, where there's a tendency to work with companies, advisors, investors that were within those. I do think that while that's not all about geography, that in an environment where geography has become less of a factor, that there is some blurring of those differences. And I also think that COVID has inspired sort of a general level of collaboration and even footing that's been interesting to see unfold. Now, whether that's sustainable or not, certainly, remains to be seen. But I feel like that, that's something that has happened over the last year, where there certainly has been some blurring of that. I wouldn't say that it is something that has impacted the way that that we've done business or executed our strategies, but I do see some changes.
And do you see a change, for example, in your outreach or in your business areas due to COVID, that you have more West Coast exposure, for example?
Well, we do have offices on the East and West Coast and have, so I wouldn't say that necessarily has changed the way that we are executing our strategy. But I feel like there has been a bit more flexibility on the part of, whether it's companies, advisors, investors across the coast to be more collaborative.
Okay.
I was just going to add one piece there, Yvonne. And I think, from our perspective, one of the things that we see when we look at, West Coast companies and in sort of versus East Coast companies is just the greater risk from an attrition standpoint on West Coast companies, and just because there tends to be so much more opportunity, whether you're in San Francisco, whether you're in Seattle, as opposed to East Coast companies. What we've found with companies that we've done acquisitions of is we tend to have greater retentive value and greater loyalty with East Coast employees than on the West Coast, where there definitely tends to be a greater level of attrition. And so it's certainly something that we take into account when we're looking at M&A targets on the West Coast.
And speaking of about you, Jeremy, you were with
with LogMeIn?
Not ClickMeIn, LogMeIn. And I recalled it because I have the GoToMeeting, GoToWebinar, whatever apps on my phone. And I mean, we saw the valuations of the Zooms and co. And I mean,
Crazy.
valuations, of course, depends, you know, they can be justified to some extent by the growth rates. But at some point, everyone has a Zoom account. So, and as you looking for M&A opportunities, how much do you see such kind of trends overhyped? Or bubbling or not? Or
well, you know, playing in the DevOps space now with progress, but certainly playing in that video collaboration space pre-COVID. You know, even pre-COVID, there was a lot of enthusiasm around video conferencing, different ways to collaborate, and I think that's only been multiplied by significant factors. But you know, certainly on the DevOps side, just given the resilience of these companies and their ability to play such a key role from a digital transformation standpoint, as Carrie alluded to earlier, you know, puts them in a position that, you know, they're continuing to get tremendous traction, and as a result, you know, can think very highly of themselves from a valuation standpoint, which certainly makes things challenging for a buyer like Progress, which you know, is a very resilient company itself, but not necessarily as fast of a grower in the marketplace. But I think that, you know, companies like Zoom and companies like GoToMeeting will continue to benefit from this shift, because I think while it certainly won't have the same level of demand that it had during the first few months when everyone was home, as people start to go back to work, I think, you know, we'll certainly see more of a hybrid approach to how people work, you know, part-time in the office, part-time at home. So there's going to continue to be a demand for those kinds of tools that sort of enable successful work from anywhere. You know, it was funny, you know, LogMeIn was basically hyped up that work from anywhere concept pre-COVID, and so some good foresight there, and has a lot of products that certainly benefit from the work from anywhere model, which I think is going to be a model that most companies are going to shift to. I mean, you certainly hear some like Netflix that are talking about everybody going back to the office, and that's just how we work most effectively. But I think that those companies are going to be more the minority, and I think the majority are going to have a more hybrid approach on a go-forward basis. So there'll continue to be demand for these kinds of tools, but I think that, you know, it should level off at some point, because the demand levels will definitely level off as well.
I'll just jump in. I also think, though, that there are certain trends, like Jeremy highlighted, that I think, you know, things got pulled forward dramatically, and I don't think we're going back. And, you know, whether it be remote work or distance learning or contactless payments or a variety of other things that we've been talking about for years, and then all of a sudden it just happened overnight. I don't think people are going back. I mean, I have a portfolio company that is in a business that provides online proctoring for test takers. And you can imagine that business performed quite well during COVID. But what's been exciting is to see that on the other, as people are getting back to some sense of normalcy, the value proposition that they experienced during COVID was better than what they had previously. So if you were, you know, taking a standardized test, you used to have to drive to a test center and you know, park and sit down and take a test for a few hours, and now you can hit a button and you can do it from the comfort of your home. After a year or 18 months of doing it in this new way, when it's actually a little bit more convenient and cheaper, I think that those changes, we're not going back to the way it was, because frankly, the value proposition is better for the way we've learned to do it now. And I think Jeremy's exactly right that while we may not all be working exactly as we're probably all working today forever, I don't think we're also going back to the way we worked, you know, for the you know, previous 100 years.
Right, and I think there's also some tools that even if we are back, you know, working similarly physically the way we used to, that, you know, we're using tools that we'll continue to use over time. You know, even if you're in the same office with, you know, some of your colleagues or clients or portfolio companies, you over the last year, I mean, I've seen a switch to things that used to be, would be a conference bridge that are now Zoom, that I don't think we would have moved to as quickly, it becoming sort of so standardized. And I think a lot of that will stick, is how we communicate with our peers and clients and customers, outside of our physical environment.
Yeah, it's interesting to see, right? Because there are some things where the test procedures you mentioned, Chris, things are just more hassle-free. So people will stay with it because it's more convenient. You are not sitting in traffic, blah, blah, blah. But at the end, people also crave for in-person meetings, right? At the beginning of the pandemic, some investors, especially early stage investors, were like, how should we do business if we cannot meet the people in person? And at some point they realized, well, they cannot sit and wait for months and years and not invest. So they all had to change their style. So, I mean, the important or the interesting question is what will stay and what will rather go back to like it was before. People talking about the new normal. I figured out that in the preparation, I had to create the word the old normal. So what will be again the old normal? Are there any bets here in the room?
So I'm not sure. I don't think we go back to the old normal at all. Yes, of course, personal meetings are important, but just here in the Silicon Valley, how many just like people like moved away permanently? Like I know general partners of funds who are just like not even here anymore, and they figured out it works, and it works for everybody. By the way, it works for startups too. So there's a big question here in the Silicon Valley at the moment. So are we going to be an ecosystem at all, like really localized ecosystem, or is this all like diffusing? I think a lot of people coming back, what will not change is maybe not so much our behavior. So I think we go back to personal meetings are irreplaceable in some cases at least, but is in my feeling at least the value that technology has. So we learned to really to really see the value in technology in so many ways because we were so dependent on it. And I think this awareness and this openness as well, this will not change. And this is a dramatic shift, that what would we have been without like, technologies like Zoom, and without like all the e-commerce and delivery services and so many others. We were so dependent on that. And before it was a commodity, where we were probably not even aware of it. And now we realize that technology actually in many areas is a good thing. And like in general in the population, and it made us very open and really regard that far more highly than maybe before. I think, and that's something that will not change. So that's really good for new technologies, for new startups and new ideas, because I think it will be adopted much easier and maybe quicker as well.
Yeah, I think, from my perspective, and, Carrie mentioned this early on, when I joined Progress, I was very concerned about our ability to do deals in COVID without like having any of that personal interaction. And, the fascinating thing is, I mean, we did the Chef acquisition start to finish without ever meeting the team face to face or in person. We leveraged Zoom. I think we benefited from the fact that the company was a very virtual company to begin with, and so even when we did the integration, which again, I'm a big believer in integration. Day one, the first week, having everyone together and being able to have sessions with HR folks, with IT folks, to sort of make that transition more as seamless as possible. We were able to do all that remotely. I think that, things like that, I look forward to being able to get back to the old normal for that, because I think that personal interaction, that personal touch is important for the success of deals and the success of acquisitions. But I think, on the front end side, I think we'll be able to do a lot more of the diligence remotely and virtually. I think that, having that personal interaction and being able to meet with the CEO and having some time with the executive team will certainly bring that back will certainly be important. But, you know, trying to gather 15, 20 people to get on a plane to fly out to the West Coast or wherever to have a 2-day management session, we can do a lot more of that effectively, utilizing, as you referred to it, the COVID style, and, you know, leveraging these tools, leveraging the technology that we now have. So I think we will end up being, you saw it in the Chef transaction, a lot more efficient because of the fact we're able to leverage all this technology. But there certainly are aspects that, you know, require that personal touch. You know, when we can get back to that, I think we'll certainly go back to that.
A different question, and this I wanted to ask this Bernhard anyway. What trends you see in the early stage investments and also in areas like mobility, because you mentioned that you are raising a mobility fund, so that you are interested in this area in particular. And then I saw there's one question from the audience regarding SPAC transactions, and what I, for example, and the question is this a fad or real? And the second question is tech also riding the SPAC wave? And as we know, because we are both in the mobility space, there is almost no LiDAR startup left without a SPAC, right?
It's true.
So my question to you would be, is there even a chance for a LiDAR startup without a SPAC exit?
Yeah, there probably is. I wouldn't go that far. But yeah, so the short answer is yes to all the questions. Maybe you should explain what a SPAC is. It's well known, very popular, became popular since 2019, especially in our venture world. It's basically what you do with a SPAC is it's basically a blank check company, right? SPAC stands for Special Purpose Acquisition Company. So what you do, you start a company that has initially no commercial operations and is just formed to basically to raise money through an IPO. So you do an IPO pretty quickly. So the SEC is not much to look at there because it's basically an empty company just with money. And after the IPO, you are acquiring one or more existing companies actually and make like a real business out of it. So this is what a SPAC does. And it's a very simple and especially much faster way basically to IPO and to raise money through an IPO. And it became quite popular. So there, I think, were about 200 SPACs last year around the world, raising like literally dozens of billions of dollars. And you're right. And especially in our mobility sector, I think there's like a good part of these 200 SPACs are like just like mobility companies and EV companies and so on. And it is a big trend. I think in a way, if for some companies, it's actually one of my former portfolio companies is like starting that process right now, what is interesting. I think in many ways it is helpful. I do not think that it will go away. Why it is like so dominant in the mobility sector, especially with LiDAR. I think it started last year with Velodyne, and then there's like there are a couple of others becoming, like I think Luminar and Avar, Auster. There are a bunch of, I don't actually know why exactly in that space it is such a dominant trend, but it is and it works, you know, so far. And I do think it's a new trend that will not go away anytime soon. Yeah. Okay,
thank you. So we already discussed some other questions. I'm still.
Can I just jump in on the SPAC for just 1 second? I think even in the last month, we've seen the market have some indigestion around SPACs. And so while there's been a tremendous number of SPACs that have gone public, their ability to get deals done over the next 12 to 18 months, I think will be very interesting to see, because in the end, the success or the ability to get the deal done is predicated around the underlying investors' belief that the stock price will go up. And given some of the recent performance of SPACs, both as they first report earnings, as well as even just as they turn from being purely the SPAC to, as Bernard highlighted, an operating entity, we've seen some real weakness in the performance. And I think it is very intriguing to me to see what happens here over the next 12 to 18 months of whether the momentum we saw in the latter half of 2020 can be sustained, or whether, like at other times in history, SPACs have become more prevalent and then less prevalent again and then more prevalent. They're certainly very prevalent right now. I think there's still some uncertainty of what the future holds.
Yeah,
Yeah, and
maybe
some
I
of
can add to that. I totally agree. So it is a trend. It went far too, the last 2 years were crazy in that regard. And we need a little bit of a contraction in the sense of that we have to, the market has to be more critical and more thorough about not everybody is like a successful SPAC. And I think there has to be like a little bit of a correction there. But I'm also optimistic that that will happen because the market will basically correct itself in that regard. But I do not assume that it's like going away completely.
Yeah, I mean, there's been a forward part of the market and a big piece of it that's been so very involved with SPACs and you know, hyping them up and getting them to where they are. But I think also a much larger part of the market that hasn't understood yet what they are and is getting there. So whether I think that the activity may not necessarily decrease, it'll change, I think, and you know, maybe become a bit more normalized over time versus you know, particularly hyped as people get comfortable with what it means to be a SPAC and you know, how they can participate on a more maybe reasonable valuation basis than has happened.
And Chris, how are you looking at this SPAC issue or SPAC topic? Is this like competitive to your PE investments, or is this more complementary?
You know, like a lot of things in life, it is somewhat competitive as it relates to certain assets that we might be pursuing. At the same time, it's frankly a potential alternative as we think about some of our portfolio companies. Clearly, a lot of our portfolio companies have been approached by some of these SPACs. And again, so we're certainly taking a look at the SPACs with a close eye. But again, I think our view is that it's not real. You don't really have a deal until the SPAC has the investor support to get the deal done.
Mm-hmm. Okay. So I think I got this one question from the audience. I don't know whether there are more questions from the audience. I don't see them. Maybe Yvonne and Carol can help me here, or whether there were more questions or not.
I don't see any at this point either. So if anybody has a question, please make sure to post them in the chat box. Thank you.
So how are we with the time, Yvonne?
We have another 5 minutes.
Okay. Actually, I'm kind of almost out of questions. I had some backup questions, but I think we covered it all. I'm asking you, what are you looking forward most after you are being vaccinated and probably able to meet people in person? What do you want to do first?
I'm certainly excited to get back on the road. I'm looking forward to banker technology conferences not being virtual, but actually getting back face to face. I'm looking forward to that. I'm looking forward to meeting with companies and having that personal interaction. I'm very excited to go out to Seattle and actually sit down with some of the executives from Chef and actually get to meet them in person and celebrate that transaction. So April 22nd is the 2 weeks from my second vaccine, so I'll be ready to hit the road and later this quarter.
I am super excited to, spend more time with my colleagues in person and with the, the management teams that I've been supporting, spend more time with them in person. And, sort of just generally get back to normal and, be able to go out to dinner in a more normal fashion and socialize. And I was actually supposed to get the J&J vaccine this afternoon, and
Not doing that now, I'm guessing.
that's been pretty disappointing, I gotta say. But
I think one thing to build on Carrie's comment about getting back together with colleagues, we've had a number of junior professionals join our firm in the last year who I've never met face to face. And I think that COVID has obviously not been easy for lots of folks, but I think I feel particularly sympathetic for individuals who've been forced to start a job and never actually meet face to face with any of their colleagues or their employers. And so the opportunity to spend some time with those individuals, to get to know them for who they are, as opposed to some of the limitations that come through Zoom, which allows them to get the work done, but potentially lose out on, I think, some of the softer mentorship opportunities that typically come from walking by somebody's office or sitting together in a meeting or after a meeting.
Mhm.
Yeah, and maybe to round this up, and it's not only business related, just like finally talk about something else and do not have this like dominant topic on your mind all the time with everything you do or say and every conversation. I'm very much looking forward to that too, just like to different topics. And I mean, there's a whole world and so many exciting things out there. And finally, get back to normal in that sense too.
And Bernhard, picking up on one of the questions from the audience, that so many deals last year were rather late stage, because then at least someone else, knows the management team. Then the company. You have much more information. So for very early stage deals, if you don't know the CEO, you don't know the management team, you cannot meet the people in person. There was probably, that might be a reason, still some hesitance. So early stage deals, there were less. Do you think this is due to COVID, or
No,
do you think there were other
not so
reasons?
much. So first, I think it is, if we really got, so the first hesitancy was there, yeah, for a couple of months maybe. But then even like big top VCs, I know one here in the Silicon Valley, one of the big names, they haven't seen like any company in a year. And they're doing investments early stage all the time. They just got used to this new model. What happens actually is that normally before that, 1 or 2 partners in a VC firm was looking at it, maybe 3. Now you often have like 10 partners on a Zoom call. So it's just like more people are dealing with the deal. But I don't think that's the reason why you see less early stage, honestly. Same thing, by the way, that's also a symptom, of the whole COVID thing. Because I'm from Germany, I also know the German market well. The last year we had so much activity for the first time actually from US VCs in Germany, or probably all over Europe, but Germany I know best. And I was always wondering why that is, but it makes a lot of sense, because once you really got used to, okay, I can do the deal over Zoom, then also it doesn't matter where the company sits anymore, right? So the German team does not have to travel to the Silicon Valley just to speak to VCs. And I think that's a big shift in general. The reason why you see more money deployed into later stage is probably because that's you often see when you have a lot or too much money in the market. You basically move or shift, you have to do bigger rounds. And you normally try to do the big rounds in the like what you assume are the 10% winners in the market, right? So that's why the like very few companies are basically getting flooded with money, because that's a natural reaction if you have to basically too much money, or if there's too much money in the market. And that's probably what you've seen last year, and maybe you're gonna see this year too. So more money to the winners. That's definitely a big trend. Yeah, but there's nothing to do with the pandemic in my view. Yeah.
Okay,
Yvonne,
I think we've reached the end.
thank you so much.
Thank you to Yvonne for moderating. Thank you to all of our panelists for all the very interesting viewpoints on what is going to happen and what we can expect. Wanted to make sure